500 companies, one fund. But is it the right move for your money? Stick around as we unpack the SBI Nifty 500 index fund and find out if it deserves a spot in your investment portfolio. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goal in a more faster and smarter way. So before analyzing whether investing in this fund will be helpful for investment portfolio in the future or not, let us first understand a few basic details about this SBI Nifty 500 index fund. So as an NFO, it opens on 17 September 2024 and closes on 24 September 2024. And some of its key features are it belongs to an open-ended fund type, it belongs to the category of equity flexi cap fund, and it has Nifty 500 TRI index as its benchmark index, and you get an exit load of 0.25% if you choose to redeem it within 15 days. And there is no entry load, but the minimum investment you need to do for investing in this fund is just 5,000 rupees, and the fund manager for this fund is Mr. Viral Chadeva. According to the riskometer, the risk involved in this fund is very high. The primary investment objective of this fund is to provide returns to the investors before expenses, which closely correspond to the total returns of the securities as represented by the underlying index, but this fund is subjected to tracking error as well, as it is an index fund. So now, as we have taken a look at understanding the SBI Nifty 500 index fund, now let us take a look at the index it is representing. So the Nifty 500 index represents the top 500 companies which are selected based on the full market capitalization from the eligible universe. So the Nifty 500 index is computed using the free float market capitalization method, wherein the level of the index reflects the total free float market value of all the stocks in the index, which is relative to the particular base period. So this index can be used for a variety of purposes such as benchmarking fund portfolios, launching of index funds, ETFs, and other structured products. Now let us take a look at the sectors represented under this index. So the sectors represented are the financial services sector, information technology, oil, gas and consumable fuels, automobile and auto components, fast-moving consumer goods, healthcare, capital goods, power, consumer services, metals and mining, consumer durables, construction, telecommunication, chemicals, construction materials, services, realty, textiles, media, entertainment and publication, diversified forest materials. All these sectors are represented under this index. So the highest weightage is given to the financial services sector, a weightage of 27.60%, while the lowest weightage is given to the forest material sector, where weightage of 0.08%. Now let's take a look at the top 10 holdings of this index. So the top 10 companies in this index are HDFC Bank Limited, Reliance Industries Limited, ICICI Bank Limited, Infosys Limited, ITC Limited, Tata Consultancy Services Limited, Larsen & Toubro Limited, Bharti Airtel Limited, Axis Bank Limited, State Bank of India. Now out of all these companies, the top first position is given to the HDFC Bank Limited by a weightage of 6.41%. while top 10th position is given to the State Bank of India by a weightage of 1.63%. Now, if you look at the index returns as on the August 30, 2024, from the data and the tabular column and the graph represented here, what we can understand is in 1 year it has given a return of 41.58%, in 5 years it has given a return of 22.73%, and since inception it has given a return of 12.98%. So from this graph we can better understand that compared to short-term period, in long-term period it has comparatively performed well. So to explore the SBI Nifty 500 index fund and analyze whether it will be a good investment option that can provide exposure to a broad range of companies across sectors, we need to find out what is the pros and cons of investing in this fund. So that's what we are going to do now. So let's start with the positives first. So one of the major advantages in this fund is the broader diversification, because the extensive diversification helps us by investing in 500 companies from various industries. So the SBI Nifty 500 index fund reduces the risk of being overly dependent on a single sector. Whether it's banking, IT or healthcare, you can get exposure to a wide array of businesses. Another advantage is the low expense ratio. As a passive fund, the SBI Nifty 500 index fund comes with a relatively low expense ratio. Since it simply tracks the performance of the Nifty 500 index, there are no high management fees involved. So this can be especially beneficial beneficial for long-term investors who are looking to maximize returns by minimizing costs. Because if you choose to compare an index fund with an actively managed fund, it will have higher costs because you need to pay the fund manager who's completely managing your fund. But here there is no fund manager involved because it's only trying to replicate the index. Management costs are very low. Finally, last but not the least, another advantage is the market linked returns. So the fund is designed to mirror the Nifty 500 index, which means you get returns in line with the overall market performance. So if the market performs well, your investment benefits directly from that growth. So these are the advantages. Now let's take a look at the disadvantage. So this fund is vulnerable to the market downturns because on the flip side, it tracks the market. The fund is equally vulnerable to market downturns. So in times of economic instability or market correction, the fund's value will decline in tandem with the broader market, offering no active protection. And another drawback is that you have no potential to outperform the market. See, if you compare this fund with an active funds have the potential to outperform the market through strategic investments. But a passive fund like this is limited to market average return. So as an investor, if you're seeking a higher returns through active fund management, you might find the option of investing in an index fund lacking. So finally, another drawback is that concentration risk in top companies. Because despite its wide coverage, a significant portion of the fund's capital is concentrated in large cap companies like Reliance, HDFC, and Infosys. So this concentration risk means that any negative performance by these top players can disproportionately impact the fund's overall return. So you need to consider all these factors before carefully choosing to decide to invest in this fund. So what is the final takeaway from our analysis on the SBI Nifty 500 index fund? So from our analysis, we can see that this one offers excellent diversification and low cost investing, which makes it a solid option for those seeking broad market exposure. But however, if you're looking for active fund management with the potential to outperform the market, this may not be the best fit. Understanding your financial goals and risk tolerance is key to determining whether this fund aligns with your investment strategy. That's why if it suits with you or not, it's completely dependent upon the investor and the factors they choose to determine which will be suitable for their investment portfolio. But our personal opinion is that if you are an ultra conservative investor who's not willing to take any risk at all, then you can choose to invest in an index fund like this compared to an actively managed fund. And also there are other similar index funds in the market that have a lower expense ratio and a lower tracking error compared to this fund, which also you can try if you still want to invest in an index fund. And finally, if you are an aggressive investor and you're willing to take a lot more risk, then actively managed funds have the potential to deliver higher returns than an index fund like this. Because as an index fund, it will only try to replicate the index and you will not be able to help see it outperform the market. So that's why if you want these factors in your investment, then you can definitely opt for an actively managed fund. And as an investor, you should always consult with your financial planner because they will help you see the suitability of your investment objective, risk profile, overlap ratio, allocation, and see if it benefits your investment portfolio or not. Because if you do not have sufficient knowledge about the market, or if you do not have the time to invest into researching about the market, then it's better if you choose to consult with a certified financial planner before choosing to invest in any fund.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.